The best time to start was yesterday. The next best time is today. Hi, I'm Elena of Financialdemics, and we are starting a new series. We are going to be talking about investing. Now, typically I talk about the foundations of personal finance, and I have a few investing videos on this channel just talking about a little bit of the basics, but I do think it's important for you to start in investing if you are not already. So I want to provide you with a few videos on how to start, why to start, what you need to do to start investing, because a lot of people are either scared of investing or they don't know how to start. They think it's this big complicated thing, and it doesn't have to be that hard, and it's something that you need to do, especially if you plan on retiring ever or you want to be in a better financial situation. With investing, is that one thing that can get you to your goal faster. Investing has been known to have a 10% return over time when it comes to the stock market, and that return is in addition to what you actually put into the account, and it actually helps the account grow, and then you have compound interest, and that is what really gets you into a position to help you actually build some wealth, but then also help you reach some of the goals that you actually have for yourself. So why should you start investing? First of all, compound interest alone is the reason why you should start investing. Compound interest is the interest that you actually earn on the money that you have invested, and then any money that you've earned on the interest that you have earned along the way. So compound interest can be your friend when it comes from the investing standpoint. So here's just a simple example. Let's say that you invested $1,000. You have a 5% interest rate. So basically over the year, you're going to earn 5%. At the end of the first year, you're going to have $1,050, right? And you might say like $1,050, but truthfully it's $50 that you didn't have to put in yourself. So you have an extra $50. And at the end of the second year, you're going to earn another 5%. But instead of earning 5% on $1,000, you're going to earn 5% on $1,050. So at the end of the second year, you're going to end up having $1,102.50. And so that's how compound interest works. It's continuously gaining on the amount that you have in the account. So it actually works out in your favor, because it's not like simple interest. You would just earn that $50 every year on that principal that you put in, which was the $1,000. With compound interest, you are earning interest on the full amount in the account every year, no matter whether or not it's the money that you contribute or the interest that you have previously earned. That is the benefit of having compound interest on your investment accounts. You also want to invest because the reality is, with any type of inflation, that inflation actually reduces your spending power when you just have money in savings. People don't actually realize that. And even though I'm a big proponent of saving, especially when you're, saving for your emergency fund or saving for certain things that are coming up, like travel, maybe weddings, maybe school, anything that you kind of have a set date on, when it comes to investing for the future and really using your funds to create a type of financial freedom, or saving for retirement, or just investing for, and let me go back. When I say saving for retirement, it is always investing. It is always investing. So just know that. Or even if you're just investing just to make sure you have extra funds, to create that growth and that wealth, you cannot just have your money in a regular savings account, even a high yield savings account. I'm sorry. And I love a good high yield, okay? I got a few that I love. But you want to actually invest that money, because what happens with inflation is, if inflation is higher than the amount that you have in your savings, then you are losing purchasing power over time. And that is not what you want, because even though you have that money in savings, if inflation is involved, then you're not going to be able to purchase the same items today that you would with, say, that same $1,000 that you would have been able to purchase last year. Typically, stocks increase with inflation, right? Their value increases. That's why they offset inflation compared to just saving your money in a regular savings account. So just for example, let's say that you just have $100 in a regular brick and mortar savings account. At the end of the year, if it's paying 1%, you're going to have $101. If inflation is 2%, you would need $102 to actually match inflation and be able to buy the same items with that same amount of money. So you want to be able to put yourself in position that, yes, you'll have your savings, right? And remember, we have certain reasons for our savings, but you want to have that money in an investment account that's able to outperform inflation. If you are looking to learn how to invest better and grow your wealth, and I have partnered with One Savvy Dollar. So One Savvy Dollar is an amazing real estate and stock investor. But let me tell you about Ogechi, who runs One Savvy Dollar. She is actually going to be running a 6-week course that comes with group coaching, and she is going to basically provide you with the blueprint to be able to grow your investment account to $100,000. Now, I'm not saying it's going to happen in 6 weeks that you're going to get to 100,000. I just want to put that out there ahead of time. She is giving you the blueprint. So you put in the time. Now, unless you have a significant amount of money to put in to get there in 6 weeks, that's a whole nother thing. But if you are a beginner investor and you're really trying to understand how to invest, understand like how to pick your stocks and which stocks to pick, know how to actually analyze your portfolio so that you are sticking with the right investments in your stock portfolio, then you definitely want to check out the link below to her The Blueprint to 100K Investing course. It starts on January 6th, and she is going to be working with you to help you understand the stock market and which stocks that you should pick. And funny enough, y'all, in 2023, her stock portfolio actually performed better than the S&P 500 index. So I think she knows about looking into stocks, understanding the stocks and how those stocks are performing so that you can invest and actually hit your financial goals. She's also going to be including some pretty amazing things with this course. Now, if you already have started investing, but you still kind of feel a little iffy about it, you still can actually join this course because she will actually audit your portfolio. So that is something that a lot of people do not necessarily offer. And so she will help you with making sure that your current portfolio is set up in a way that can create the growth that you are looking for from your investing portfolio, and you're going to be able to take a look at her investing portfolio. So you would actually be able to see what she's investing in and how it's performing. Now, this course does have lifetime access, okay? But even after the 6 weeks is up, you're still able to go back and reference so you can make sure that you're on the right track to hitting your goals. And she'll also be providing you with all the tools and the templates and PDFs and everything you need to be able to be successful. So if you are interested in this course, I have dropped the link in the description box below. Definitely check it out. I know Ogechi personally, so I know that she's good at what she does. I know that she is very successful when it comes to her investing, and she's very successful in real estate, I might add. So I would not recommend this course if I didn't think this course would be able to help you set up your portfolio in a way to reach your financial goals. So if you're interested, definitely check the link in the description box below. Go ahead and click on it and sign up because you don't want to miss her next cohort that is starting on January 6th. So now let's just talk about the different types of investments. When I talk about the different types of investments, I'm not talking about the types of account. I'm talking about what investments are actually in the types of accounts. So this can happen if you have retirement accounts like 401ks, 403bs, 457bs, IRAs, any type of IRAs. So that's a traditional or Roth. Or this can happen in a non-retirement account where you just have an account that is considered after tax, right? Because it's not retirement and you're just investing in this account. So there are different types of stocks. Of course, there are bonds, mutual funds, ETFs, real estate, and there's more investments, but I want to stick with this group of investments just because the other investments that I could mention, they have a higher risk to them, and it's not something I'm going to tell you to stay away from. But if we're talking about just kind of like beginner level investing 101, I definitely want you to just understand the basics first, and then that's the advanced classes. Like, think about when you're in college. Like, those are the specialty classes when that's an interest of yours and you want to look into that later. Okay, first let's talk about stocks. When you buy a stock, you are buying ownership into that company that is being traded on the market. Typically, they fluctuate in price. So one day that your stock may be worth one amount, the next day it may be worth another. And that's just due to like the market, like how people feel in the market, what type of conditions are going on, how the company has performed, or how people feel about the company. I will say that I think it's very important when you're getting into investing to understand that an investor's sentiment about a stock doesn't necessarily have to be your sentiment about the stock. And I will say sometimes an investor, and when I say an investor, it's typically like something comes out about a company. Sometimes they are correct in where that company is going to go, but sometimes they're not. And so it's up to you to kind of decide how you're going to react to that news or not. So just keep that in mind. In this case, we're talking about if you're going to buy and hold your stock. So it can be used for long-term growth. So using it for retirement, or like I talked about, that after-tax account where you're just looking to grow your wealth. So you could use stocks to grow your wealth over time. And there are so many different types of stocks that you can actually diversify your stock investments. All stocks do not have the same goals per se. So there are different goals that you can use with the type of stocks that you invest in to be able to reach your wealth goals. Next, we could talk about bonds. Bonds are basically like making a loan to either a company, a municipality, which is typically like your local government, or the government, like the federal government. And basically you make that loan to them, they give you a bond, and they're going to pay you back with interest over time. They're typically less volatile than stocks. And then also they normally have a fixed maturity date. So that's basically when they're going to pay you back, and a fixed interest rate. So the amount of interest that you should be receiving for providing that loan. Bonds are typically known to preserve capital. Like if you're looking to preserve your capital and you're looking for some type of income, but you can get income from stocks too. I'm just letting you know, because dividends are a great thing. And so that is what typically people like to use bonds for. Bonds are still used a lot, but I remember bonds were huge back in the day. And you still can invest in bonds now, but I just remember bonds were the thing. I think people felt more comfortable with bonds. And I would say during that time frame, the interest rates were higher, so the payment on bonds were pretty great. I will also mention that investors can use bonds to diversify their portfolio. And what I mean by diversifying your portfolio is if you are looking to have a mix of different types of investments in your portfolio, and you want something to offset the performance of stocks, then typically bonds is one of the options that is used to do that. Because the way it is typically taught, which is sometimes different now, but the way it's typically taught is that when stocks are doing well, bonds are not, and when bonds are doing well, stocks are not. So it is something that kind of keeps your portfolio in balance during the economic changes that would typically affect your investment accounts. Next are mutual funds. So mutual funds are basically multiple stocks and multiple bonds in an actual fund, and is actually managed by a fund manager. The basic thought process behind mutual funds is because you pool your money together with other investors to invest in this portfolio that is being managed by a fund manager, it actually allows you to get into multiple investments at a time through that one fund. The one thing to keep in mind is that you can have a mutual fund that is actively tracked or passively tracked by the fund manager. There are fees that are attached to that mutual fund just because typically you got to pay the fund manager, right? And it can be good for investors who are looking for more diversification, maybe less risk than just being in a stock. And especially if you are the type of investor who you want to buy and hold, but you're a little bit more cautious and you're not sure if you're going to keep up with what's going on in the stock market, then a mutual fund can be an option for you. I will also say that you still have that ability to choose a fund that really aligns with your goals. And there's different types of funds. As I mentioned with the stocks, there are different types of stocks out there that have certain goals. And so you can easily find a mutual fund that aligns with that. Now, if you want something similar, but maybe for reduced fees, then maybe you want to look into ETFs, which stands for exchange traded funds. So ETFs are very similar to mutual funds, but they trade on stock market exchanges similar to the individual stocks. As I already mentioned, there are lower fees and they can track an index. So think of the S&P 500. They can track a sector. So sectors are like healthcare, financial services, real estate, tech, energy, or they can track a commodity, which when I think of commodity, I always think of gold, but it could be like precious metals. And even though I mentioned energy for a sector, energy can also be considered a commodity, or it can be like an agricultural product. I think ETFs can be great for like any type of investor, especially because they do have those lower fees, because fees affect our return, right? We want more money in our return. We don't like to pay fees anywhere, no matter investing, bank fees, credit card fee, none of that. And I think there can be a good option if you are looking to get into like different sectors. As I mentioned, diversification many times already in this video. If you're looking to diversify, then ETFs might be something that you may want to look into. The next section is real estate. So with real estate, you either can be investing in actual physical properties or real estate investment trusts, where I talked a little bit about real estate investment trusts in this video right here. So I'm going to link it here if you want to hear more about those and ways that you can bring in additional income. Now, real estate investment trusts typically own and or manage properties, and they bring in their income through rents or either dividends. Now, you can purchase properties through cash flow and invest that way, but the way that I'm discussing in this case is through real estate investment trusts, that you can invest that way because it gives you that freedom to invest in real estate without having to actually manage the properties. And if you have never managed a property, I'm telling you from experience, it's definitely, it's not an easy feat per se, just depending on where the property is, if the property is older, the type of tenants you have and things like that. So if you are looking for a way to get in the real estate market without actually owning the properties, real estate investment trust is an option for you. And you can do that through an investing account. And I lastly will mention like index funds. I'm going to mention it I'm gonna mention it this way because you can invest in an index fund either through like a stock or through a mutual fund or ETF. But basically, I actually referenced it earlier where it follows a specific index. That index has multiple stocks in that index. So I already mentioned the S&P 500. So when you look at the S&P 500, they typically have the 500 leading companies in the US in that particular index, and based on how those companies is performing is how that particular index fund perform. The one thing about an index is if you are looking to invest, it moves with the market. So it's a way that you know if how the market is doing. Typically that index is somewhat doing the same. And so not that it's necessarily a passive investment, but it is something that you don't necessarily have to check every day. Let's talk about some of the misconceptions when it comes to investing. I think the one that I've heard the most, at least in the church environment, is they've heard that it's gambling. But the thing about gambling is you only win when you're gambling if somebody else loses, right? There's no ownership involved in gambling. Either you win or you lose. When it comes to investing in stocks, you actually have ownership. When you buy a share of stock, you have ownership in another company. You get the earnings added to your account based on how that company performs. So I don't see how you can consider it gambling. Does the amount go up and down based on how the company's doing, the performance, the economy, and investor sentiment? Yes. But does somebody actually just lose and another person win? That is not exactly how investing works. Can you lose some of your money? Is that a risk? Yes. But depending on where you are in life, if you hold on to your money long enough or hold on to that stock long enough, if the company's not, going down or anything like that, then you could gain that money back. I'm telling you this as a person who went through the Great Recession in 2008. I have recovered and more than doubled my money. A lot of people also feel like you need a lot of money to start. And truthfully, that's not true. Now, maybe back in the day, but now there are so many ways to start investing. There's a lot of companies out there that have a $0 minimal investment. You could start with like $50 or $100. So you don't necessarily need a lot of money to start investing. I would name two companies that I feel are companies that are reputable. I definitely know Vanguard has $0 account minimums, and so does Fidelity. And then there's a lot of other companies out there that I have come across that have $0 investment minimums. And the last thing is it's too risky. The only thing I have to say to that is no risk, no reward. I don't know what else to tell you. You're taking on inflation risk if you just have your money in a savings. I hope this video was very helpful for you. Make sure you go ahead and hit that like button. And if you are not subscribed, what are you waiting on? Because most of y'all not subscribed. Y'all just be watching. I'm gonna need y'all to go ahead and subscribe down below and check out this video right here.